Hey investors, welcome back to Markets Analyzers. Today we are tackling another crucial financial document, the balance sheet. If you enjoyed our previous video on the income statement, you are going to love this one. The balance sheet can seem complex at first glance, but we are here to simplify it for you. So grab a seat, relax, let's dive right in without wasting any time. But hold on, come on everyone, do hit the like and subscribe button. If our videos being liked by more people means those videos in particular are getting good reach. So please try to like the video and share the video and channel with your friends as well. What is a balance sheet? Alright, let's start with the basics. What exactly is a balance sheet? A balance sheet is a snapshot of a company's financial position at a specific point in time. It shows what the company owns, assets, and what it owes, liabilities, and what's left for the owner's equity. It's like a financial selfie of the company, capturing its financial health on a particular date. Think of it this way. If the income statement is like a report card showing how well the company did over a period, the balance sheet is like a photograph of everything the company has and owes at a specific moment. It is divided into three main sections: assets, liabilities, and equity. Let's break down each of these sections. Assets represent everything a company owns that has value and can be converted into cash or used to generate income. An asset is a resource that is expected to provide a future benefit to its owner. Individuals usually think of assets as items of value that they could convert into cash at some future point and that might also be producing income or appreciating in value in the meantime. Those can be financial assets. Things like stocks, bonds, and mutual funds are physical assets like a home or a real estate. In case of a business, an asset may be something that has the potential to generate cash flow, reduce expense, or improve sales, regardless of whether it is a tangible asset like manufacturing equipment or a piece of a land or a fleet of trucks or an intangible asset like a patent or a trademark. They are usually categorized into two main types: non-current or long-term assets and current or short-term assets. Non-current assets and current assets. Non-current assets are long-term investments that will provide value over several years. Simply understand, if the company has the asset for more than 12 months, 1 year means they come under non-current assets. They will be converted into cash only after 12 months. Non-current assets may include items such as land, property, plant and equipment, trademarks, long-term investments. So all those things comes under non-current assets. Whereas current assets are assets that are expected to be converted into cash or used up within a year. They are used to fund immediate or current needs of the company. They include things like cash, accounts receivable, money owed by their customers, and inventory, goods ready to be sold. This is the difference between non-current and current assets. Read them by pausing the video. You will understand clearly. Next, we have liabilities. Liabilities are what the company owes to others. Assets are what the company owns, and liabilities are what the company owes. They represent obligation that the company must pay in the future. Like assets, liabilities are divided into two categories, which are current liabilities and non-current liabilities. Current liabilities are a company's short-term financial obligation that are due within 1 year. These liabilities are essential for understanding the company's short-term financial health and liquidity. Some examples of current liabilities are accounts payable, money owed by the company to its suppliers for goods and services they received. Things like short-term borrowings, loans, and other forms of debt that must be repaid within a year. So such things comes under current liabilities. If you are finding it hard to understand now, you will definitely get good understanding when I explain with a real company. So for now, try to stay on course. Non-current liabilities, also known as long-term liabilities, are financial obligations that a company is required to settle after more than a year. These liabilities are essential for understanding the company's long-term financial health and debt structure. Some examples of non-current liabilities are long-term borrowings, things like loans and other forms of debt that are due after more than a year. Maybe lease liabilities, obligation under long-term lease agreements. So this is the difference between non-current and current liabilities. Read them by pausing the video. To sum up all we have learned until now. First, assets, things which puts money into our pocket. Maybe our job is like an asset because it puts money into our pocket. Whereas liability is something which takes money out of our pocket. Something like a loan is a liability because it takes money out of our pocket. Finally, we have equity. Equity represents the owner's claim on the assets after all liabilities have been paid off. It essentially what's left for the owners after all debts have been settled. Equity includes items like common stock, money invested by the owners, retained earnings, profits kept in the business, and other reserves. Equity represents the value that would be returned to a company's shareholder if all the assets were liquidated and all of the company's debts were paid off. Equity is the net worth of the company. I hope you found this video helpful until this point. If you did, please give it a thumbs up, share it with your friends, and subscribe to Markets Analyzers For more financial insights, hit that notification bell so you'll never miss an update. So until now, you might have got a vague idea of what a balance sheet is. On the balance sheet, we will find what the company owns and what the company owes and what is remaining for the owners. So now I'll explain a balance sheet with a real company. Let's take Tata Power for continuation purpose. This is Tata Power balance sheet. You can view this from their annual report on page number 412. We will look at only most recent numbers, which are 31st March 2024 numbers. All the numbers are mentioned in crores. The first section we see in this balance sheet is assets. As we spoke earlier, assets are something which puts money into our pocket. The assets are divided into non-current assets and current assets. First, we will talk about non-current assets. Non-current assets are long-term investments or properties that a company expects to hold for more than 1 year. These assets are not necessarily converted into cash within a year. So for Tata Power, if you look at below, total non-current assets are worth 1,02,789.45 crore. It's a huge number, right? 1.02 lakh crores. Here is a detailed breakdown of the different types of non-current assets. First, property, plant and equipment. This includes touchable assets, tangible assets like land, building, machinery and equipment, which are used in operations. If you want an example for Tata Power, this might include power plants, office buildings and machinery used to generate electricity. The total value of those assets is at 59,624 crores. I'm only giving a general explanation of what it means. If you want a more proper and perfect answer, in the balance sheet next to each heading, you will find notes and page number to that notes. For property, plant and equipment, they gave notes 4 and page number 433. It means in that report, go to page number 433 and see notes 4. They will explain what comes under property, plant and equipment and the value of each will be explained in an elaborate way. I would encourage you to do it to get better understanding. So if we add all this, we will get non-current assets, which comes at 1.02 lakh crore. In the next section, we have current assets, which comes at a total of 27,264 crores. And there are few special category of assets called assets classified as held for sale and regulatory deferral account assets. So if we add all of them, we get total assets which are worth 1,39,553.49 crores. Coming to next section, we have equity and liabilities. Let's talk about equities after discussing liabilities. As we said earlier, liabilities are two types, non-current and current liabilities. First, let's speak about non-current liabilities. Non-current liabilities represent the long-term obligation which the company intends to settle or pay off not within 365 days or 12 months of the balance sheet date. These obligations stay on the books for few years. Non-current liabilities are generally settled after 12 months from the reporting period. So these are all non-current liabilities for Tata Power, things like borrowings, provision. So the total non-current assets are 59,252.77 crore. Next, coming to current liabilities. Current liabilities are a company's obligation which are expected to be settled within 365 days, less than 1 year. The term current is used to indicate that the obligation will be settled soon, within a year. Going by that, non-current clearly means obligation that extend beyond 365 days. All this comes under current liabilities for Tata Power. The total comes at 41,137.97 crore. These two sections, liabilities directly associated with assets classified as held for sale and regulatory deferred account liability, both these comes under other liabilities. So if you add all these things, we get 1,01,220.72 crore. Now we have learned about assets and liabilities, what the company owns and what the company owes. I hope you found this video helpful until this point. If you did, please give it a thumbs up, share it with your friends and subscribe to Markets Analysis for more financial insights. Hit that notification bell so you'll never miss future updates. Now still there is one section left, which is equity section. In the equity section, which is an integral part to the balance sheet, comes under liabilities section. It is highlighted in the snapshot below. Many people find this term a little confusing. On the one hand, if you think about it, we are discussing liabilities that represents the company's obligation. The company should pay the liabilities to others. On the other hand, we are now trying to discuss the equity, which represents the shareholders' wealth. This is quite counterintuitive, isn't it? How can liabilities and equity appear on the liabilities side of the balance sheet? This is a question which bothered me in the beginning days for a very long time. After all, the equity section represents the funds belonging to the shareholders, which in the true sense is an asset and not really a liability. Then why is it coming under liabilities? To make sense of this, you should change how you look at a company's financial statement. Think about the entire company as an individual whose sole job is to run its core business operations and create wealth for its shareholders. So company is separating. By thinking this way, you are in fact separating the shareholders and the company. company is a separate individual and shareholder is a separate individual. The individual company is doing everything to create wealth for the shareholders. With this new perspective, now think about financial statement. One side shareholders and other side company. Both are different. This also means the shareholders' funds do not belong to the company as it rightfully belongs to its shareholders. Hence, from the company's perspective, the shareholders' funds are an obligation payable to the shareholders. This is shown on the liability side of the balance sheet. I hope you got it. Next, under equity, there is equity share capital. To understand equity share capital, think about a fictional company issuing shares for the first time. Imagine company ABC issues 100 shares, with each share having a face value of rupees 10. In this case, the share capital would be 10 into 100,000. Tata Power has a share capital of 319.56 crores. Equity share capital represents the portion of a company's capital that is funded by the shareholders in exchange for ownership rights in the beginning stages. Next, there is other equity, which is nothing but funds belonging to the shareholders, but the company is keeping them in reserves. So finally, this is what the company owes to shareholders. Balance sheet equation is assets is equals to liabilities plus shareholders' equity. I hope I have explained everything in a clear and understandable way. If you want deeper explanation on any particular topic, please comment. I will try to explain. I hope you found this video helpful until this point. If you did, please give it a thumbs up and share the video with your friends. And subscribe to our channel Markets Analyzers for more financial insights. So here is a quick snapshot of what we have learned until now. Total assets, which are worth 1.39 lakh crore. Non-current assets, which are worth 1.02 lakh crore. Current assets, which are worth 27,064 crores. Total liabilities, which are worth around 1 lakh crore. Non-current liabilities, which are worth 59,252 crore. Current liabilities, which are worth 41,001 crores. And equity, which is worth 38,332 crore. By examining these numbers, you can see how Tata Power is structured financially and get a sense of its financial health. So why is this balance sheet important? Investors, creditors, and analysts use it to assess the company's financial health, understand its debt levels, and evaluate its ability to generate future profits. It is an essential tool for making informed investment decisions. And there you have it, a comprehensive yet simple breakdown on the balance sheet. I hope you found this video helpful. If you did, don't forget to like, comment, and subscribe to our channel Markets Analyzers.